Okay, good afternoon, everybody. So I'm Lucrezia Reichling, and I will be chairing this panel on Sustainability Disclosure Standards. And we'll have an hour, so there are, I think, between 200 and 300 people virtual attending. And actually, for those people, just, if you want to ask any questions, so you have to go into the system, which is called Slido, I think. And then the code work is sustainability. And then at the end, I'll try to give you room for Q&As. So before I introduce the speakers, just let me say something as a matter of introduction. You know that 20 years ago, the global financial market did not have the benefit of having comparable standards for financial reporting. Now we have achieved some global understanding on how the financial statement has to be prepared. I'm saying almost because the standards are not exactly identical. The IFRS, the International Financial Reporting Standard Foundation, is preparing the standards for more than 140 countries. The US has different standards, but there is some kind of ideas of convergence, and there is a regulatory dialogue which aspires to convergence. Now, when it comes to sustainability, we are not in the same place, okay? And although there are lots of standards which have been suggested by different private organizations and so on, I mean, I think that the corporate world is facing with quite different ideas on how the information should be disclosed, and this has created problems of comparability. Also, the standards are typically non-mandatory, and therefore they're not audited, they're not assured, and so on. And this is a problem for financial stability, because there are risks which are not properly recognized. And when we think, for example, of climate risk, this is becoming more and more a tangible problem. And then more generally, it's probably this has led to capital misallocation, which is something that is worrisome, since we need to mobilize private capital for the climate transition. Now, recently, a lot has happened, however, in disclosure, and there are two main initiatives which we are going to focus on today. So the first initiative is the International Sustainability Standard Board has been established at COP26 more than a year and a half ago. The ISSB, the chair is here, Emmanuel Faber, operates under the umbrella of the IFRS Foundation, which is responsible for the financial reporting standards. And the ISSB has been working on proposing standards which are designed for investors, and they apply to the company's annual report and build on the existing voluntary standards that were already existing and in the market and have been around for more than 10 years. The goal of the SSB is to suggest standards, to set standards at the global level, and to have what they call an international baseline for climate and more sustainability, general more sustainability disclosure, that then different jurisdictions can be built on depending on their policy objectives. So that's the first initiative. And then the second initiative is the European Union adoption in 2022 of the next generation sustainability disclosure rules, which is called the European Sustainability Reporting Standards, that implement the Corporate Sustainability Reporting Directive. Now, these standards are not just designed for investors, but they are integrated in a more general public policy framework that the EU has related to the Green Deal and so on. So the architecture of the two standards is different, the conceptual framework is different, and so, we want to understand today a little bit more about how can we live with this difference and to what extent we can reach interoperability between the two standards to make sure that investors and preparers don't go mad, right? Because they have to prepare these documents. So today, this is what we're going to talk about. So let me introduce the speaker. We have here John Berrigan, the Director General of for DG Financial Stability, Financial Services and Capital Market Union, FISMA. And then we have, Emmanuel Faber, who is the chair of the newly established International Sustainability Standard Board under the umbrella of the IFRS. For transparency, I must say that I'm a trustee of the IFRS, so I'm not a complete, independent observer in this discussion. And then, we have Massimo Romano, who is the head of integrated reporting at Generali. And I think it's very important to have him here because he has to give us the perspective of the private sector and the investors and the preparers of the account. So we're really looking forward to get your views, and I hope you're going to challenge these guys. So let me start with the first question. So the first question is, what are the differences and similarities between the EU standards and the ISSB? I will start with John and then go to Emmanuel and then to Massimo, and you have 5 minutes each for this question. Thank you. John.
Okay, well, thanks, Lucretia. I suppose it's important I explain how these standards fit into a much bigger frame in the EU, because it's important when we come back to talk about convergence and how we can manage it. Disclosures are part of a very big EU policy framework around the Green Deal. And then within the Green Deal, we have what's called the Sustainable Finance Framework. And the Sustainable Finance Framework has essentially 3 blocks, which is the taxonomy, a set of definitions of what is green and what not green. Well, we don't do too much of what's not green, do a lot of what is green. A disclosure regime based on those definitions, and then a set of tools for the investor to use. So it's in this second block, the disclosure block, that we talk about today. But just to make clear that this is locked into a policy objectives of the Union, which I'll use to explain a little bit the 2 fundamental differences between the ISSB and our standards. As you rightly said, within the disclosure, we already have financial reporting. Now we're going to have sustainability reporting. We adopted the CSRD, or the Corporate Sustainability Reporting Directive, in the end of 22, in which there are reporting requirements. And within that legislation, there then is the commitment to provide standards against which those reporting requirements can be met. And we have outsourced or asked EFRAG, which is our standard setter, to prepare those standards. And they have been working on that project since and even before 22, if I'm honest. They have submitted to us a first set of standards. We have consulted on those. They contain 12 draft standards. We have 2 cross-cutting general standards. Then we have 5 environmental standards, 4 social standards, and 1 governance standard. That's what's on the table now, has been consulted. And our intention is to move forward with adoption towards the middle of this year. That's our plan. So they are the idea is that they will be available for the first set of reporting requirements, which must come in financial year 2024. So therefore, 2025 published reports. Now, you will probably be aware, and I think I will anticipate your question, the Commissioner has already said we're going to slow down a little bit here, because we have another set of standards coming forward, which we were intending to work on with EFRAG and consult. We will slow down a little bit here to allow the market time to absorb this first round of standards, because when you see them, they are quite substantial and they need to be looked at. So this is where we are now in the project. And of course, we had started this process before Emmanuel arrived and the ISSB came into view. So we were a little bit ahead, which made it, of course, difficult for us then to align with the ISSB, because we were already somewhere else. It would anyway have been difficult for us to align with the ISSB, because, as I said, we are locked into a policy framework, which is, at least for the moment, a little bit different from what the ISSB is managing in 2 big respects. One, our scope is wider. So at the moment, the ISSB is focused on climate, we are also focused on climate, but also, as you know, under the taxonomy, we have environmental objectives also, and our standards are moving wider than climate because our disclosure requirements are wider than climate. So that's the first main area of difference, is that we have a wider scope. I don't know, the ISSB is starting with climate, perhaps in the future they go further, but for the moment we are sort of legally required to do it this way. And then the second big difference is this wonderful single materiality versus double materiality. I'm not going to exaggerate on this, but it is important to understand that in our framework, we're not just looking at the sort of financial impact of sustainability risk, we're also looking at the kind of impact of the company on sustainability. So this is the second materiality, and that comes from the fact that our disclosures are part of a framework which is in the Green Deal. So we're not just about managing risk that is coming in, we're also managing risk that is being created going out. And so these are the two big differences I see. When I started looking at this with Erkki Liikinen a while ago, I think it was even before Emmanuel came, I thought we're never going to make this, and we're going to look very different in the outcome. And this is going to be a problem for guys like you, because ultimately the objective here is for money to flow into the right investments. And this is something we need to keep in mind. We can have accounting purity, but ultimately the objective is that money flows. But it flows to the right place. So it must flow, but it must flow into the right investments, sustainable. So there's a balance to be found between what this objective and how pure we can be, let's say, in our definitions and what we want to do. What I found is that once Emmanuel arrived and Patrick de Combourg and Emmanuel got talking, there has been an amazing convergence, if I would be honest, much more than I think I and Erkki and myself really thought. We kind of demanded it, but didn't think we'd get it. I let Emmanuel tell me what the percentage is in terms of convergence, but I think it's remarkably close compared to where we started. But we will not be really able to compromise on these two main problems, which is our scope will have to be wider, and this double materiality will have to be a feature of our reporting requirements. But having said that, we want interoperability. We never promised 100% convergence. I have never, ever stood on a public podium and said I can assure 100% convergence between our standards and the ISSB, or indeed anybody else's standards which are not converging to the ISSB. But we can, I think, work to make them interoperable, manage divergence, whatever the phrase you want to use, to a point where we can limit the frictions to the extent where we will allow the money to flow and flow on a global basis. And that is the objective. So not perfection, but pretty good.
Okay, thank you. So John has already said quite a bit. So maybe it would be good if you could explain what is the real difference between single materiality and double materiality for what concerns climate, because in any case we start with climate. And then, of course, you talk about whatever you want to talk about. But, I mean, I think that this is particularly important, I think, to have your definition.
Yeah, sure. Yeah, thank you, Lucrezia. And I can really start indeed from what you just said, Sean. I'm 100% in agreement with what you have shared here. And for our audience, I'd say, let me illustrate the differences I see from our angle. Maybe one thing that Sean said about the fact that ESRS are part of the broader framework of CSRD, we are in a different place. We do not have a legal framework of application. So our way of adoption is actually going to be a dual approach. One is a regulatory approach that will go through the endorsement process of IOSCO, which through their membership then, by endorsing our standards, will engage with jurisdictions who may or may not use our standards in the future. And again, we do not have that constraint, but we do not either have the teeth that the ESRS will have by being immediately embedded or have been even from scratch embedded into a legal framework. The second layer of that is that, as Lucrezia said, Lucrezia, we inherited a number of private initiatives, the ISSB standards, the IR, the Integrated Reporting Framework, the CDSB framework. TCFD is really looking at ISSB as their standard setting legacy. They've been among the ones, the FSB and TCFD, to really call for the creation of ISSB. And so we've embarked all these those frameworks, which happen to be very used in a number of countries already, and we therefore expect that our standards would also be used by companies and investors on a voluntary basis, simply because they replace the previous generation with a seamless language that describes non-financial matters in financial terms. So that's the one thing I would mention. The notion of financial materiality versus impact, or single versus double, I don't think we should enter into this debate personally here, because it would be much longer. But I think it transpires into two ways. First, we do not have the remit of full materiality. Everything which align with the IFRS accounting, basically, everything that will be reported in our standards is deemed to be part of the general purpose financial reporting in order to inform investor decisions and indeed to have capital flows moving. So we want to move market pricing. We want to move cost of capital of banks, insurers, of any company, because climate change is a risk overall, as the FSB has realized when they embarked climate as part of their mandate in 2017, the Financial Stability Board of the G20. But if you look at it from a micro economic standpoint, the effect of climate change is going to be that it will provide a radical shift in competitive advantage. So maybe we like it or not, but it's both a matter of risks and opportunities. If you can think about the risks that are coming, the true climate risks that are coming are offering companies, depending the way they respond to that, and they alter their strategies and get funding for altering their strategies at the right price, they will have a competitive advantage that will be different. Water access will definitely be a topic that was never discussed, and that's going to be front page. So we are here to make sure that the market has a price on those topics. We are not looking per se as an NGO would, or a sovereign country would, or a municipal community would look at the impact of that company on the local water. We are looking at it if it has a financial impact for the company. And so it translates in two things of difference. One is a number of the ESRS are said to be mandatory. They are not subject to entity assessment and materiality. And a lot of that in climate actually is mandatory, because this is the EU policy. We do have a huge part of our substance, I would dare to say, I don't know, 70, 80%, I mean, really huge part of our substance which is similar. But in our standards, they're subject to investor materiality, what really matters for the economic decision. In the ESRS, they are part of being mandatory. Whether it's important deemed to be important by the company or not, still they have to report. Outside of the ESRS, for us, we recognize the importance of the policy making, and so we have a global agreement with GRI, which is the biggest and longest experienced private standard setter in impact materiality, to provide a seamless suite of solutions of ISSB on investor materiality, GRI on impact materiality, with no overlap, hopefully, and no gap for companies that would need to, or that would want to report on a full materiality perspective. So we have found a partner, basically, to complement the policy side of things that we cannot, as part of the IFRS Foundation, look at as far as we're concerned. The last thing I would say, if you allow me, Lucrezia, briefly on interoperability, because I'm sure we will discuss that, but there are, as absolutely as Sean said, I mean, in all fairness and reality, Europe started before we started, and it was very difficult to imagine how indeed we were going to be able to converge in this. We focus on climate because we started with a specific climate standard in addition to our foundational standard. because the market told us climate is the biggest topic you should start with, and that's why we're there. We will develop additional standards as soon as next year, and which will be available in 25. But we started with that, and as part of that, we regrouped with the FISMA team and EFRAG, and have tried to make sure that we had a clear view, not about an equivalence, it won't happen, but an interoperability. So there will be a way, hopefully avoiding the dual reporting, for companies to prepare from ESRS to move into ISSB with a navigation tool, which we hope is going to be a short one. And on the other side, for ISSB preparers to prepare for ESRS by basically adding those requirements that we do not have, which would be very policy specific, that the ESRS has. And this is the discussion that we are finalizing in the, I guess, next coming weeks, really, and where also we believe that there could be opportunities for the Commission to look at the trade-offs that they need to make in maybe simplifying or phasing a bit, as you said, John, some of that, because the substance of our climate standards are so close now.
Okay, thank you. I mean, we're going to go to Massimo, but I just want to add one thing, because I found that when I go and present these things, people are confused on the materiality issues. I mean that the ISSB standards, for example, ask companies to report on emissions. Okay, so the fact that they are investor focused and enterprise value focused doesn't mean that the standards don't have to require the reporting on emissions, which is what companies do to the environment, because it is recognized that there is an interaction between the two levels. So sorry, I just want to clarify, because this is always a question. But Massimo, so how do you see it from your point of view? Okay.
Thank you. Thank you, Lucrezia, and I'm very honored to be here in front of these two very relevant speakers. And I would like to share with all of you the finance perspective from the practitioner standpoint. And I will try to point it out three main topics and possible solutions. So first of all, I think that we are in front of the most monumental change management journey. So this is not just a reporting, this is not just compliance, but it's a change management transformation journey. In a very, very challenging environment, COVID, the war, the inflation, and for insurance sector, IFRS 17 and 9, which is now live. So we have to be aware that companies like Generali is facing an incredible challenge environment. Now I'm going to focus on the CFO role in this perspective. I think that CFO has an incredible challenge in front of him or her, because it will enlarge the scope, at least in Generali, to supporting the business function to work on these requirements. And this is really, really important. And at the end, this is really a strategic activities, and the reporting is just the final moment of truth. So again, this is not a reporting exercise, it's for sure a reporting exercise, but it's the end of a journey. So what is the solution? A phasing approach. We have to prioritize, and we welcome the decision of the Commission to focus, to prioritize on some very large, in a way, set of standards. The second connected critical points is we have to get the right people with the right skills. And this is an incredible challenge that we are facing now and in the next 2, 3, 5 years. Because, again, in finance, we will need people that are able to read the ESG factors plus the traditional reporting stuff. And therefore, here is strategic to invest in training and in education. And even here, we welcome the EFRAG effort to invest on that. But again, as a practitioner, I see really as a critical point the skills, the right person and the right skills. And finally, I would like to provide some practical evidences of the complexity that we are managing in the current environment, because these data points must be workable in the real life. And I make some example in order to avoid that, to have a full compliance, just compliance exercise, you know. So in the CSR framework and in EFRAG draft, we have some mandatory quantitative KPI. And in some specific cases, these KPIs could be negligible for the group. I know that this is very relevant for instance, for the SFDR KPIs. But practically speaking, for instance, the water pollutants for an insurance sector, for the own operation, very likely is negligible. And therefore, to make it workable, could be very useful to introduce some sort of flexibility, giving the responsibility to the preparers to state that. But it's completely different to state that or to produce a number, with all the data quality issues and the additional cost. The second element is the scope out for some specific situation, like an acquisition. Imagine to have an acquisition in the last quarter of the year. Today, I should report for the new not listed group that I'm acquiring, all these data points, which is basically impossible. So I think it would be important, like today, to introduce some exception that could be disclosed, but are really common sense, I would say. And finally, linked with the first one, if a KPI is relevant, for instance, after double materiality exercise, could be not relevant for some small entities. So in this context, the KPI is relevant for the group, but if for some small entities, I give you the example of the water consumption. Water consumption could be relevant for the group, but for some controlled little entities, might not. And therefore, even in this case, could be allowed to have an exemption disclosed, of course, but it will be much more workable than today.
Thank you. But on the question of the relationship between the two standards, so the ISSB and the EU, as a preparer, do you have enough clarity of this interoperability that we talked about?
Well, not really, but let me be very straight here. As a preparers, I would like to have a situation where if I'm compliant with the CSRD, automatically I'm compliant with ISSB. I mean, all the additional activities that I should perform to link the two standards, it's an additional cost for sure. So we welcome the extraordinary effort, and in terms of change management, even for you guys, this is very relevant, and we appreciate the great effort that you did to make the two words talking. But I think that there is an extra mile to do that here, because it will be very painful for preparers to reconcile these two visions. So ideally, the target is to have an equivalence. So if I comply with the CSRD, there is a mechanism that I'm complying also with the ISB. So I don't know how to get there, but this is the target.
One more question for you, if you don't mind, because I don't know if everybody in the audience understands that these standards is not just about reporting numbers, right? But it's also about scenarios, and it's also about, explaining how the business is adapting to transition risk and so on. So it seems to me that there is almost, is very close to risk management in a way, okay? So the boundaries between risk management and reporting are narrower than in financial reporting. So there is a more clear
Absolutely,
separation, so.
absolutely, Lucrezia. And that's the reason why I'm saying that this is a change management project, a journey. Because you have to put all the stakeholders in the corporation on the same table and set up the right reporting process to get there. And it's cover all the value chain, and is really a strategic activity, starting from the strategy, the targets, the action, and finally the reporting.
Real revolution, yeah. So let me go back to the global thing. I mean, of course, here we are in Europe and we are obsessed about Europe, but capital market is global. And so it's important to have a mechanism for global convergence. And this is what the ISSB aspire to. So, Emmanuel, if we go beyond Europe there are some large area of the world, like, for example, the US and so on. What are the difficulties there? So I would like you to talk both about the US, which is obviously important because that's, basically where the capital market is, but also about emerging markets where the difficulties could be actually just capability so how do you deal with that stuff?
Yeah, thank you, Lucrezia. Well, first of all, I say, as I just said before, we really see the adoption and the use of our standards as a function of both regulatory and voluntary use by the market participants. And this is the case, I think, for both of the examples you mentioned. So the US SEC has come out with a pretty forceful proposal a year ago, suggesting scope 1, scope 2, and scope 3 material. I think it came as a surprise to many of us that they would be so aligned with our own and with the Europeans' requirements when it comes to greenhouse gas emissions. The fact is that they know they will be extremely challenged in their ability to maintain their ambition in the final standards. And so at this stage in the US, I think there is a lot of uncertainty as to how far the regulator will go in actually ruling on those topics. There are other ways of soft regulation and soft guidance that they can give to the market, but we would not expect that the US market is going to be mostly driven by a regulatory adoption. So it means that the US market will be about the large investors really pushing for the need of having transparency on sustainability risks and opportunities for the reasons we mentioned before. And as Romano said, it's a matter of embedding those topics in the strategy. And as you said, Lucrezia, it's not just about metrics. It's really about understanding how the shift in the business models are going to happen. And therefore, it's much more a grammar than an algorithm that we're developing here. Emerging countries, very interestingly, Nigeria, South Africa, a number of others have already approached us, actually announced that for Nigeria that they wanted to be early adopters at COP27, because they see the adoption of our standards as a way to attract capital that will build a resilient economy in their countries, an economy that will not just look at the short-term profit, but really at the resilience. And the world climate resilience is in our standards, and it's actually a requirement that companies present their climate resilience plans over the short, mid, and long term. And so we both have, I think, going to have probably quite a wide adoption in the global south, which I think is also good for jurisdictions as Europe, because the supply chains, the value chains are global, as you said. And if our standards are working in other places in the world, I think it will be beneficial for European users reporting under CSRD, because the quality of the data downstream and upstream their value chains will be better. Because we know that there could be challenges there, but also for smaller companies, and that's true, of course, in OECD countries, in the EU, US, etc., or Canada. We have introduced basically two things. One, a number of scalability and proportionality reliefs in our standards. Speaking from the point of view of actually something that exists in the IFRS, which is the notion that you shouldn't do something you're supposed to find out and report information that is reasonable and supportable. And we also have this notion of without undue cost or effort, which really talks to the fact that even though there will be pressure from financial markets for more transparency, companies that are smaller are not expected to do what large, bigger companies would do. We've developed from TCFD and others a lot of guidance as to how you calculate your scope 3, for instance, from primary data, verified data, secondary data, emission factors, and then broader emission factors. So gradually it will not be perfect, but we're saying, actually, by the way, you're authorized to use estimates. You're authorized to use ranges. You can re-update your estimates. You will have a safe harbor statement for a number of years, so that that language of scope 3, that revolution that needs to happen, can start without perfection being here, because perfection will never be here. So that's really the first layer, which is building scalability and proportionality mechanism within the standards themselves. The other thing is, so ISSB has got 2 vice chairs. One is Hugh Lloyd, she was the vice chair of IASB, of course, and she's an incredibly powerful and strong standard setter for us. But the other one is Jingdong Hua, who's the former treasurer and vice president of the World Bank. He's now full-time with us as a vice chair based in Montreal, with one mission: capacity building. As the vice chair of the board, it's, for me, very clear in our governance that both standard setting themselves and capacity building, both of them warrant a vice chair position, a leadership position. And frankly, I think 30% of our task and work and resources in the next 12 months will be devoted to this topic of capacity building. And that's one of the reasons why we've actually been public yesterday with a paper that, for a decision next week, that we will expand the option for 2024, which is our first year of effective date, reporting in 25. The standards are expected to be finalized around the end of the second quarter this year. So 24 is the first effective date. But we are considering giving option for companies that are not prepared for them to report only on climate on 24, as opposed to reporting on all the sustainability risks and opportunities. Again, as a matter of making sure they invest the time they need to understand their supply chain mapping, their value mapping, and then they can be prepared in 25 to really go forcefully on the whole package.
John, the EU has a long tradition of being an exporter of regulations. So do you see yourself also having a global role? And, or, are you happy to, to participate in the governance of the ISSB, IFRS, and to collaborate also on the evolution of the standards at the global level?
A couple of things to say here. I mean, yeah, we have a history of establishing standards. It's not a competition. These standards are not chosen by us. They're not imposed on us. Other people adopt them as their standards. So first and foremost, the EU standards are for the EU. They're based in our law. They're for us. The interesting thing about climate, however, is that you cannot combat climate on your own. So of course, we want the rest of the world to be ideally as ambitious, but certainly sufficiently ambitious around us to make this policy actually work, because it can't work in the EU alone. So therefore the ISSB, I think, has an important role to play. I'm accused of having invented this phrase, global baseline. I deny it fully, but if it is there, we would like it to be as ambitious as possible, obviously, and we will support. We are a long-term supporter of the IFRS, so we're not sort of abandoning our interest in international standards in any way. So yes, we support it. The only issue we had, of course, was that it doesn't, as of yet, cover everything that we cover. But we certainly will be supportive of the ISSB as a standard, and we'll certainly be encouraging other jurisdictions around the world, if they can't come to us, to at least come to the ISSB. Yeah? I don't mean that at least as to suggest it's not, but if you don't like EU standards, then take these ones, and that's why it was important for us to get them as interoperable as possible. So I think we are, as I've always said, card-carrying members of the Global Convergence Club, and we like international rules. So we will continue to push, and we will support the ISSB in that. One thing that's interesting, I want to come back on some of the things Massimo said. This is not a static discussion. We're talking today about a situation, but these standards, I think, are quite likely to evolve over time. I think the ISSB will evolve its standards. We will have to, we're not going to just sit here and say these are the same standards which will apply forever. It is a change management issue, and I agree with that. And I think also reporting, is a means to an end. I have to keep reminding people that reporting is part of this bigger story about achieving an end. And I know we're putting a lot of pressure on you, but somebody told me that 2050 is the end, okay? So if we're not ready by 2050, I'm not a climate scientist, so I take it for what it is. So we're late. So we know we're moving very fast. We're moving fast in the entire sustainable finance agenda, not just on disclosures. We're pushing you, we're pressuring you, but there isn't a lot of time. So I think we do have to, get this balance right. If we overdo it, it's not going to work. But if we underdo it, let's say, it's also not going to work in terms of our ultimate objective. So it has to be a partnership, but there's going to be a degree of pressure from our side. We will not want to but we are going to continue to push on that. We have consulted on these standards quite widely already. EFRAG has consulted. We now will consult on the standards we will put out based on what EFRAG has sent us in draft. So there will be opportunities for us to talk more and to refine if needed. But I don't want to lose this point that there is a degree of urgency here, so which means there is a degree of pressure in the system. Nobody wants to overdo it so that we kind of don't meet the objective because we pile on too hard. But also you have to realize that if we don't go fast enough, we also will not meet the objective. So the objective is not to report. The objective is to reach targets by 2050.
Before I turn to Massimo, I have a question for you. So in Europe, there are lots of SMEs, companies, and a lot of companies are not public companies. So how do you plan to, work with those entities? And isn't this a problem of capabilities similar to what Emmanuel referred to when talking about emerging markets? And
we approach that in two ways. The first way was for the actual reporting regimes themselves. If you look in the CSRD, we have a proportionate regime for SMEs. In fact, they have opt-outs if they want to. The problem with opt-out, of course, is that if you opt out, then you opt out of the green finance flow. So, it's in your own interest perhaps to opt in. And then for those who opt in, they get a proportionate, lighter requirement. Of course, one of the problems will be that the larger companies may require reporting from the SME. And that's something we will need to talk to the companies about so that they don't, we will pressurize them, that they don't pressurize too much on the other end beyond what is capable. So that's something we will have to watch, all right. But in terms of proportionality, we are aware that SMEs have lower capabilities. The point is made to me, however, that SMEs tend to have simpler business models than the larger complex. So even reporting may not be so complicated for them, so long as we keep the proposals in line. And just to be clear, on our materiality, we have mandatory requirements on the climate, because as Emmanuel said, it's a policy, we have clear policy objectives. On the others, there will be more materiality in, so you will have options to say, this doesn't apply for me. So in the broader environmental biodiversity type standards, so there will be more materiality there. But on the climate ones, yes, we have been quite strict in terms of what we want to come back, because it is a policy and we have strict objectives there.
Massimo, for the large companies like Generali, what about the issues of data? And since you are supposed to report on Scope 1, Scope 2, and Scope 3, so the whole value chain, upstream and downstream, do you find any challenge about data? And how do you see this?
A lot of challenge here. Data gap for sure is one of the most critical dimension. The magic words, I think, are external certify data via a standard platform. And in this perspective, I want to challenge the audience on the European single access point, because we do believe that we have a fantastic idea, a framework, this EU data hub to collect all the information that are needed for the market, and therefore this will be a vital transformation phase in this journey. Consequently, we do believe that it's very urgent to have strong governance and stakeholder and expert input involved. Of course, the adequate funding of this platform it's vital as well, and there is a need to have even here an ambitious timeline with a phasing approach because the development of the ESAP is really crucial for preparers. And in terms of data, we believe that ESG data needed under EU taxonomy, CSRD and SFDR should be prioritized. They are more important in this context than the financial, prudential and other type of information. So we do believe that here there is a very important activities to be run. I think that everybody will benefit for that because I give you a practical example. Now with the EU taxonomy, we are facing a lot of problems with the external data providers to get the information for the investees. So with the XBRL and the taxonomy for DSG data, they will improve, but the only way to have an ideal situation is really to establish and run this European single access point. So I think this is really crucial in this context.
But what comes first, the disclosure or the taxonomy? Because the taxonomy needs disclosure, right? Because if in the situation in which all companies disclose, then...
Well, now in the journey, all the preparers are disclosing the taxonomy, but the XBRL for ESG are not there. They will come in 2024. And after that, I think will be crucial to set up the ESAP in order to have the data hub where everybody can go there, download the data, and produce the reporting. And you see the benefit in terms of cost, comparability of data, and so on and so forth. So I think this is really crucial in our journey that I agree with you is strategic.
Do you have anything to say on this data issue and from the ISSB side?
Yeah, thank you, Lucrezia, and thanks, Massimo, for bringing this. Yeah, it just came to my mind two things here. One is, of course, data is crucial. I mean, I've been the CFO, the CEO, the chair of a company and signed accounts for like 25 years in my life. So I know the feeling and the change management that you guys are going through. And data is the essence if we want to have that solid. The two things that are coming is, one is, we are going to have to start conversations with our EU colleagues, by the way, as part of our jurisdictional working group that meets every month, where we have Sven and Patrick and others at FISMA. But we also have China, the UK, the US, and Japan with us. And we are going to start the topic of data interoperability next month. For the first time, it was established the first time in May 22, so April or May 23, we're starting that. And we are doing that because of something that happened at COP27, and that shows how much data is going to be structuring. CDP, which is one of the largest data platforms for climate, water, and deforestation, the former Carbon Disclosure Project, has announced an agreement with us at COP27 that starting 2024, all the climate data on their platforms should be formatted against our climate standards. To be reported in 25. So among the 20, so CDP is 20,000 companies reporting that account for about half of the total global market capitalization. So it's a huge impact in terms of embarking those companies into the reporting on climate data. But of course, immediately the question is about 3,000 of them are in Europe. And on one side, they have already committed that they will continue, of course, to disclose to the international markets on CDP, and at the same time, they will have to use the European data for their own requirements with this CSRD. And this is why I totally agree that not only it's important, but it's now urgent that we have that conversation about the convergence of data globally.
Okay, thank you. So I just have one final set of questions, and then we'll turn to the floor. So your role, Massimo, is, you're Chief of Integrating Reporting at Generali. So integrating reporting means what exactly? So do you see the future in which, basically there will be one document connecting the financial statement with everything else, and this will, change completely the way in which you manage the data and the management of the data within the companies? And
a true believer of integrated reporting, but even more of integrated thinking, because integrated reporting mirrors integrated thinking in the organization. We started as a Generali back in 2011, the integrated reporting journey, and we delivered the first integrated report in 2013. So we have a solid background here. And we took practically a strategic decision to consider the integrated report our management commentary. And we welcome the decision of the Commission to oblige to put all this information in the management commentary, because this is the ideal host to have all this information. The risk we see here is that the management commentary could become 1,000 pages if we are not able to manage it properly, and therefore this overload of information will kill the usability of this information. I like to see the opportunity to have a management commentary where I have a core information, and then I will connect this core information inside the doc or outside the doc to more reports. We like to use the core and more reports presentation in Generali. This, in our opinion, is very effective because it allows the readers to focus on the core information in one doc, which is the management commentary, and to connect the other information in other documents, in the website, and so on and so forth. Well, today, in the current environment, it will be difficult to have a management commentary as whole core information because too many data are there. But we have to, in my opinion, to elaborate with the concept of core and more in order to have a more effective communication strategy here.
Thank you. So, Emmanuel, just if you could spend 2 minutes, tell us how the ISSB plan to go beyond climate and broaden the scope of the standards.
Well, it's hard for me not to react to what Massimo said about integrated thinking and reporting. I also signed my first integrated reporting in 2013. So, and I've really felt that it was a super interesting journey for us as a company and for our investors. The integrated thinking is indeed, for me, what is at the core of integrated reporting. And this is why we brought it, as I just said to start with. Integrated Reporting Council is now part of the ISSB. And at the core and even the front of our S1 foundational standard, we have now inserted the protocol of integrated thinking. We go by saying that the financial value that a company creates is inextricably linked to its stakeholders, the civil society with which it operates, and the natural resources that it draws upon. And we're therefore calling for companies to make sure that they protect, they develop, and they regenerate those capitals: human capital, social capital, natural capital. This is in the standards of ISSB. And I think it's important because it, in a way, crosses this question about impact or double materiality. We are encouraging companies to measure their impact in economic terms. We're not saying to an NGO, but in economic terms, but to make sure that they regenerate that. And this is where I think we're also, in a way, embarking on a sustainable macroeconomic model and just not microeconomic model. Now, I fully support what's been said about the 100-page, by Massimo, about the 100-page management commentary, or actually any report, because ISSB is actually gap agnostic. It's not only IFRS, it can be done in the US, turnkey, for instance. Because one thing that we are obsessed about is not obscuring the materially economic decisions. So we cannot live with 1,000 pages of documents. We only want those information that are brief and in a manner which is brief, not obscured, and very clear, so that users can actually make capital allocations, whether they are banks, insurers, or equity providers. That leads me to the point of how we are going to broaden our scope. So from climate, we will go into other immediate capitals. We've started already research on climate-related biodiversity topics, climate-related deforestation, water topics, climate-related social topics, including just transition. So as we speak, we're working on just transition with a view to potentially bring more pixels to our climate standards, because we know that the social feasibility of the transition, as the IPCC report has just said, scientifically, social science shows that not dealing in an equitable manner with adaptation, maladaptation they call it, is going to make the transition impossible. So we translate that into how companies need to incorporate that aspect of equity in the way they change their business models. So we expect that to be probably on the market around 25, which will be right after our 24 effective date. And we're going to consult beyond that on the international applicability of our industry-specific standards, the ISSB standards, on which we're working. I think by 24 that should be done. And we are launching a request for information in a few weeks' time for 4 more topics, more general topics: human capital, human rights, natural ecosystems, and integrated reporting, by the way. And all of that, and I'm saying this because we are here in Brussels, I think it's relevant for all of you here, we also would like to make sure that we build on what has already been done. And so I'd like to say that we're already referring ISRS in our hierarchy of where we see that preparers, if they do not find what they need with ISSB standards, they may consider using ESRS to fulfill the ISSB standards. And so it would be logical for us that Sean was just alluding to biodiversity, for instance. We would use the work that ESRS has done on biodiversity to also look at how we are going to create our own biodiversity standards, ensuring, again, as much as possible interoperability with our European friends.
John, the last word is yours, so that on these matters, but if you don't want to comment on this, or I had an original question, but I see that is also coming from the floor, so I'm going to ask it again. You have started with that, but maybe it was not enough detail, but the questions that are coming from the floor is how will the 25% simplification of reporting requirements announced by President von der Leyen be carried out? Which topics will be affected? Do you know, is there anything that you can tell us? Or
I mean, not a great deal in terms of, I mean, I think there's a few things to say here. Firstly, the 25%, I think is a commitment which I would not say is down to the last decimal point. I mean, I think this is it's a political indication of a direction of travel. Okay, so the message coming out is that me, and others have to be more careful in terms of the balance we strike between the reporting requirements and the burden that those reporting requirements imply on business. I don't actually, as I was saying to Emmanuel beforehand, I don't know how to measure 100% of the burden, so therefore I can't reduce it by 25%. But I think the direction is clear. There's to be that rebalancing must take place. And I think that's one point. The second point I make is it's not across the board. So it's not that everybody has to cut every reporting requirement by some quarter of amount. So this will be overall in terms of what the Commission does. So I do not know where this is going to come up in the end. But the direction of travel is important, because I always have to remind people that the standards that we're putting out is not some obsession of EFRAG or some obsession of the Commission, just as the ISSB standards are not the obsession of the ISSB, this is an investor-driven project. You know, companies want finance. The investors want to provide the finance, but they need certain information to do so. So it's a balance. So we do not want to overburden companies, of course, but if companies want investors to invest in them, I mean, this is the standard requirement of financial reporting. You have to provide a minimum of financial reporting if you expect investors to invest in you. It's very much the same here. If you want to access the green financing flow, you're going to have to provide investors with the information they want in the format they ask for it. And if you think back to all our consultations and yours as well, this was directed, what do the investors want? Now, that being said, we have to be also, and this is the message from the president, we have to be mindful that we can't overburden the company either. So this, as I said at the very beginning, is a balance. So we need to find that balance where the companies are not overburdened, but they provide the adequate amount of information to actually attract the investment that they want and that we want them to get, because we want, and then ensure, of course, that the investor is happy that when he invests, the money actually goes to where it was supposed to go. So it's a balance. It's always a balance. Everything I do in my job is a balance, and we need to find it. So.
Okay, so there are a few questions here. Well, one is for Emmanuel, that you just stated that equivalence will not happen. This is terrible news for EU companies operating both in EU and in an ISSB jurisdiction. Why is this choice?
I don't think I just stated it, but I said it multiple times, and I'm ready to repeat it again. So yeah, there will not be equivalence. For the very reasons that I think Sean and myself explained. CSRD answers policy-making statements. We are about investors and market functioning. So that cannot be equivalent. If that was equivalent, we wouldn't have been working on interoperability for the last 9 months. But yet, what we are providing, and we hope to be providing, is the avoidance of dual reporting on whatever is similar. I think that is our joint objective. That EU adds more because they have a political objective is exactly what I think reluctantly Sean's accepting the paternity of the word global baseline. Global baseline is what we do, or we work for that to be the global baseline, but then any jurisdiction can add more. And so that's why I think we cannot speak about equivalence. We're speaking about a mechanism that ensures that there is this interoperability. Whatever is in the global baseline will not be repeated as part, or will be deemed in a way equivalent by ISRS. Whatever is in the global baseline in ISRS will be deemed equivalent, not repeated, to be translated into ISSB.
Okay. Yes, down there. I have one question there.
Thanks very much. Simon Zadek, Nature Finance. Really very interesting comments. Thank you. Obviously, super important. My question concerns forward guidance. So
we're not in a central bank here. No, sorry.
Forward guidance. So what's happening in the market is increasing demands to understand the risk profile over an extended time horizon. So the transition plan scenario models, if you like, but how that feeds back into investor level risk. And of course, we know through many, many years the challenges of regulated forward guidance being a standards disclosure requirement. So I'm keen to understand, Emmanuel, or indeed others, kind of what your current thinking is, given that it is these forward-looking risks and opportunity variables that are going to be so critical for investors to understand when considering information disclosed. Thank you.
Maybe I can start with the thanks, Simon, for the question. I'd say one thing. The cultural revolution or the change management that Massimo was talking about, 90% of market capitalizations today is forward guidance. 70% of balance sheets of large companies is goodwills and intangibles. Goodwills currently occur when you make an acquisition and a merger. When you acquire a company, you do a discounted cash flow. There's a terminal value in this discounted cash flow. That terminal value is designed as growth to perpetuity of my cash flow, less interest rate divided by cost of capital. So the goodwill, which is billions in accounting of companies today, have an assumption of what is the terminal value, the growth to perpetuity of cash flows. So just that, for me, makes me quite relaxed about the ability for management to provide a 5-year, a 10-year, maybe even a 30-year range of risks and opportunities in guiding about scenarii that need to be super solid scenarii. Probably, personally, I would prefer, and we are guiding to off-the-shelf scenarii, whether they are IPCC or NGFS or International Agency of Energy, whatever. So yeah, I'll stop here because it could be very long, but I think we need to change the mindset in accounting that is too much said about the fact that accounting is simple because it's looking backwards. It's not true at all. And I think we need to have this phasing where, as we said, estimates are okay, ranges are okay. Re-updating those ranges over time is okay. It's not a perfect science, it will never be. But nor is accounting. Just another fact, 80% of entries into accounting are estimates. They are estimates already today. So I think it's that change management in which and through which we need to go. I think it's very important to provide safe harbor statements. We're going to make recommendations to jurisdictions in our discussion with IOSCO and others. If we want that we start learning this completely new language, I'm totally with you on that, we need to open our eyes and mindsets and therefore be protected for all of us who haven't practiced yet that language and have different abilities to do so in the short term.
Do you want to add anything?
Well, first, I would defer to Emmanuel's vastly superior knowledge of these accounting matters than mine. But one thing which links back to the conversation we've just had, I used to be rather skeptical about transition planning because I thought transition planning would be overly burdensome on the company. Until I started speaking to accountants who were telling me, well, the company's doing this anyway. So if the company is doing it anyway in order to produce its financial reports, it probably should use these to attract them. So we are quite keen on transition planning now because, in fact, this is one area where I think the balance is okay. There's not going to be an additional burden, and the companies can use it to their advantage in attracting sustainable finance.
There was a question on the second row there, but no? No, okay, so then you, first row.
Thanks a lot. I'm Stefano Spinaci from the European Parliamentary Research Service. So the first question is there any equivalent to the platform on sustainable finance or to the NGFS with regard to the subject of corporate disclosure? The second is about reconciliation. So just take these words from the title, how we can reconcile the regulation and the standards with business, especially the medium-sized business, and with citizen. And I give some more. So with business, I mean, how they cannot feel that they are in the trap of a competition between standard setter. And with citizen, how we make readable this disclosure also for citizen, or the user should be only the financial sector and professionals. And then the third point, last, is the practical implementation. I think is very important, the subject of data, but it's also very important the subject of how you treat this data, software, and the interoperability of this software. And this is not easy because it takes time. Any IT project is not 1 month. Thanks.
Who wants to answer to that? John, you want to?
If I understand correctly, I don't think there is. I mean, we have a platform. This is our international platform for sustainable finance. Yes. No, I mean we. This is a fairly unique thing in the world, We can pick what subjects we can put on, and we have taxonomy as one of the subjects. We have not put in any detailed disclosure because we have the ISSB essentially. So this, I suppose, you are the platform. But and in fact, to be honest, our sustainable finance platform, the international platform, came about because there was an issue of discussions at global level. I will not go back in time, but there was a previous time when it was very difficult to have discussions around sustainable finance issues at the global level. That's not the case anymore. So this platform emerged from that sort of environment. I don't think it's still very useful. We keep it, but the ISSB is, in a sense, the international disclosure platform. I believe. I agree with you on disclosures. I don't think citizens fully understand any sort of reporting from corporations, and maybe they shouldn't. In fact, in a sense, we can make the idea of disclosure, and that's something we're trying to do now in terms of our outreach, is to explain how disclosure fits into the broader agenda for sustainable finance. Because people tend to think the sustainable finance framework is rocket science. It's complicated and it's detailed, but it's not rocket science. It's market organization. You have a set of definitions, you have a disclosure regime based on those definitions, and a set of tools that allows the investor to navigate through the market. It's complicated, but it's not rocket science into something. And so I think we're trying to explain how disclosure fits in, but I'm not sure we're ever going to get to the point, and I don't know, Emmanuel, you can tell me, where we'll be able to explain in layman's language either financial or sustainability reporting. Okay, I think. And just to come back on the ESAP, it is an interesting experience, because ESAP did not really start as a sustainability project. It was item number 1 of the Capital Markets Union project. It was really the EU EDGAR, essentially. But now, of course, we see another use for it, which is sustainability. And so, of course, it's even more important. We have it financed for a while, and it would be important that finance continues. But yeah, it's interesting that something which started as a sort of broader capital market project has kind of taken on this additional importance as well.
Okay, one last question. Okay, here, and then, okay.
Thank you very much. My name is Bridget Cosgrave, and I'm from the company Sopra Steria. I have 2 questions. First, in a personal capacity, 35 years ago when I graduated from business school with an MBA, knowing my NPV project calculations was critical, I'd like the speakers to comment on how management education and particularly professional qualifications are being adapted in order to ensure that the skills are needed are available for the market. That's the first question. And my second question was related to the ESAP. I think it has been covered by the prior question.
Yeah, this is...
Well, let's comment.
Oh,
Jeremy Zettelmeyer, Bruegel. This is maybe for you, Sean, and it may very well be a dumb question. So can you just explain the logic behind the second materiality dimension? So that does this reflect sort of a belt and suspenders approach, that if investor discipline fails through the channel that has been explained by Emmanuel and others, you still know how that company is going to affect risk in other ways, and so then you can maybe regulate it, or at least what is happening if they don't actually adapt themselves. So what is sort of the theory of change, or the policy rationale behind that?
So I think we just, if you can answer to both questions, and then we conclude, because we are already running out of time.
So, yeah, thank you. I can start briefly on the question of education. It's fundamental. I think, of course, business schools and many others need to adjust their curricula over time. Some have started already a long time ago, but not enough. And so no doubt that it's a new economic language that we're developing here. And academia research and many others need to happen to nourish that as well, of course. Very short term, as far as we're concerned, We are part of the capacity building programs that we're developing are being developed with professional accountants. So the accounting profession and the auditor's profession, the assurance. But for in a way, it's clear for us because we want that connectivity with the financial statements. We want one single general purpose financial report to be hitting the desk of decision makers that will be able to look at both the financial statements and the sustainability disclosures at the same time and make appropriate capital allocation. So we need the verification, the assurance of our standards to be done by auditors of the company. Again, there may be other policy objectives in Europe, or if you take GRI, for instance, that could mandate other assurability and verification, but that's where we are. And so we're working with the Pan-African Federation of Accountants with the same, they're similar in Southeast Asia, in Latin America, CPA Canada, in the US, in Europe as well, with that profession and many others to ensure that they learn, because we have got so much to learn. They will need to attract people as well. And the scarce resources of people that know how to manipulate those data and this information is going to be very high on demand on the market. And this is why as well, we're back to universities and graduate business schools and programs to make sure that the generation of those are coming a little bit the same as in China, where 25 years ago, you had 1 million of engineers coming out of schools every year for like 10 years. That's the sort of change management that we need to have to ensure that the CSRDs and others objectives are being met.
I can do justice to this, and so Emmanuel will tell me where not. But I mean, there are two materialities. There's the financial risk to the company, and then there's the impact risk on the environment. And this is why I said at the beginning, I'm rather optimistic around double materiality, because in fact I think the difference between us will not be as big, and is not as big as ultimately we thought. So there's a financial risk to the company, which is this first materiality, which is measured. If I interpret right from what Emmanuel said, also in the ISSB, there's the sort of indirect financial risk to the company that comes from the impact the company has on what it does. So is it basically building risk on its balance sheet by what it does? But there's another force of risk, which is the impact the company has on the environment, which is not reflected in the financial risk of the company. This is what I think Emmanuel mentioned as the sort of NGO type of risk. I wouldn't put it that way, but it's right. So this is the one that where we go beyond. So we're also interested in the impact the company has on the environment, which does not, in fact, have any feedback to the company. What is the difference between these two things? I think it varies from company to company.
My question was why?
Why? Because this is the Green Deal. We are not only interested in how environmental developments affects financial risk in companies. We are also interested in how the behavior of companies impact on the environment. Now, to the extent that, as I said, there is indirect risk for the company, we can reasonably expect the company to take care of that. It's a bit like credit. You have to worry about your accumulation of credit, but also the way it's working.
Here, okay, so because if the market were internalizing all these risks, then there wouldn't be any difference, right?
Well, why would a company is not going to internalize that risk?
Okay,
It has no impact on it. And we do.
Okay, so we are running out of time, so thank you for the speaker.
Thank you.